Welcome to this session where we take a bird's eye view of the FX market. In this session we will consider the overall size of the market, what the most popular types of instruments are that are being traded, who's doing the trading, and the most popular currencies and currency pairs. All of the data has been sourced for the Bank for International Settlements Triennial FX Survey, which was last published in 2025. In terms of daily turnover, the overall volumes in the market have generally increased year on year. Here we can see that going back to 2010, the daily turnover was just short of $4 trillion a day. Now, just to be clear, that is 4 followed by 9 zeros. By 2025, this had increased to about $9.5 trillion. Also, as a point of clarification, the deals are not double counted in this survey, so a single transaction is only counted once, despite being reported by two different institutions. So what type of transactions are being reported? Well, a spot deal is where currencies are exchanged 2 days after the trade date. An outright forward transaction is where the exchange is agreed for settlement longer than spot, say 1 week or perhaps 1 month. FX swaps are a combination of a spot and an outright forward transaction. For example, buy US dollars today for euros for spot value and agree to reverse the transaction perhaps in 1 week's time. A currency swap can be thought of as a long-term contract that is made up of a series of consecutive FX swaps all executed at the same rate. An option contract is a forward contract which allows the buyer to walk away from the deal if the market moves in their favour. Typically, most people think that the spot product dominates the market, but we can see from the BIS survey that it indicates otherwise. The most popular transaction, which makes up about 40% of the market, is the FX swap. As a side point, spot transactions make up only about 30% of the market. What we will see in a later module is that rather than think of an FX swap as a combination of two FX deals, it's perhaps easier to look at it as a form of collateralized borrowing. When it comes to the type of entity trading FX, the BIS survey starts off with 3 main categories. A reporting dealer is typically a large investment bank. A non-financial institution would capture corporates and perhaps individual retail traders. We'll cover the third category of other financial institutions in the next slide. What the slide shows is that the market is dominated by wholesale financial institutions, and the somewhat noble preconception that corporate hedging of imports and exports constituting a significant proportion of the market is simply not accurate. So who are the other financial institutions? Non-reporting banks include smaller regional banks. Institutional investors might include insurance companies and general asset managers. They need FX to facilitate their purchases and sales of foreign shares and bonds. Hedge funds and proprietary trading funds are more view-driven in their approach, which is perhaps a polite way of saying that their activities are more speculative in nature. The official sector covers central banks who might deal in the FX market to supplement their monetary policy activities. The BIS survey shows that the market is dominated by US dollar transactions. The figures suggest that 89% of all transactions will include a dollar component. Thereafter, the major currencies are euros, yen, and sterling. Prior to the adoption of the euro, dollar Deutschmark was the dominant currency pair. So perhaps it is no surprise to see that the euro-US dollar now holds that mantle. Thereafter, dollars against yen, sterling, and Chinese yuan represent some of the more popular currency pairs. In terms of trading locations, London has traditionally dominated, and the most recent survey confirms that most FX business originates from the city. After New York, the 3 major hubs are all based in Asia. So what are the key takeaways? Well, the FX market continues to grow and currently trades about $9.5 trillion a day. The most popular product is the FX swap, which should be seen as a form of collateralized borrowing. The market is primarily dominated by wholesale financial participants. The dollar still remains the dominant currency, with Euro-US dollar being the dominant currency pair. And finally, London is still the global centre for FX trading.